In a world full of noise, one channel brings clarity, creativity, and growth. This is ELUNA Media.
Before we jump into the secrets, let us make sure we all understand the basics. What is trading exactly? At its simplest, trading is the act of buying and selling assets, things like company shares, currencies, or digital currencies, with the goal of making a profit. That is it. Buy low, sell high. Simple idea, but the execution takes skill. Now there are 4 key terms you are going to hear constantly as a beginner. Let me explain each one with a real example so it really sticks. Term 1, bull market. A bull market means prices are going up. Investors are feeling confident and optimistic. Money is flowing in. Think of a bull, it charges with its horns pointing upward. That is your memory trick. Example, a stock was trading at $10. Over the next few months, it rises to $18. That rising environment, that is a bull market. Term 2, bear market. A bear market is the opposite. Prices are falling. Fear is in the market. People are selling. Confidence is low. Think of a bear. It swipes its paw downward. Price is going down. Example, that same stock that was $18? It falls back to $9. Bear market. A broker is the platform or company that connects you to the market. You cannot just call up the stock market and say, "Give me some Apple shares." You need a broker. They are the middleman who executes your trades on your behalf. Examples you might have heard of, eToro, Robinhood, or Binance if you are into crypto. Term 4, portfolio. Your portfolio is your total collection of all the investments you own. For example, you might own shares in 3 different companies, plus some Bitcoin, plus a little gold. All of that together, that is your portfolio. Now here is something I want you to remember before we move on. And this surprises a lot of people. You do not need to be rich to start trading. Many platforms today let you open an account and start with as little as $10. The important thing is starting smart, which is exactly what this video is about. Secret number 1. Understand the market before you trade. Alright, secret number 1. And this one sounds obvious, but you would be shocked how many people skip it entirely. Secret number 1 is, understand the market before you put any money in. There are 3 main markets that most beginners start with. Let me walk you through each one, with a real example of how profits work. Market 1, the stock market. When you trade stocks, you are buying a small piece of ownership in a company. That piece is called a share. Example, let's say you buy 10 shares of Apple, ticker symbol Apple, at $180 each. That costs you $1,800 in total. Now imagine Apple releases a great new product, people love it, and the share price rises to $220. You now sell your 10 shares at $220 each. That is $2,200 back, minus your original $1,800, giving you a profit of $400. Not bad for holding a stock for a few months. Market 2, the Forex market. Forex stands for foreign exchange. In the Forex market, you are not buying companies, you are trading currencies against each other. For example, you might trade the US dollar against the euro, that is written as US dollar to euro. Let us say you buy when the rate is 1.05, meaning $1 buys 1.05 euros. Later, the rate moves to 1.12. You sell. That 7-point move is called 7 pips. In Forex, pips are how profits and losses are measured. Here is a fascinating fact. The Forex market is the biggest financial market in the entire world, with over $6 trillion traded every single day. Market 3, the crypto market. Crypto is short for cryptocurrency, digital currencies that exist only online. The most famous one is Bitcoin. Others include Ethereum, Solana, and hundreds more. Crypto is known for being high risk and high reward. Example, imagine you bought Bitcoin when it was at $30,000. You hold it, and over time the price rises to $45,000. You sell. That is a $15,000 profit on one trade. But, and this is critical, it can also fall just as fast. Crypto can drop 30 or 40% in a single week. So you must respect the risk. The rule for secret number 1 is this. Never trade a market you do not understand. Before you put any real money in, spend at least 2 to 4 weeks studying that market. Watch videos. Read articles. Use a demo account to practice first, which I will talk about in Secret 5. Secret number 2, risk management. Protect your money first. Secret number 2. And honestly, this is the most important secret in this entire video. If you only remember one thing from today, let it be this. Secret 2 is risk management. Protect your money first. I want to say something that surprises most beginners. The best traders in the world are not the ones who make the most money. They are the ones who lose the least. Read that again. Protecting your capital is the number 1 job of a trader. Because if you lose all your money, the game is over. You cannot trade from zero. Let me teach you 3 tools that professional traders use to protect their money. Tool 1. The 1 to 2% rule. The rule is simple. Never risk more than 1 to 2% of your total trading account on any single trade. Let me show you how this works with 2 real examples. Example 1. Your account has $1,000. 2% of $1,000 is $20. That is the maximum you risk on one trade. Example 2. Your account has $5,000. 2% of $5,000 is $100. That is your maximum risk on one trade. Now here is why this rule is so powerful. Even if you have 20 losing trades in a row, and trust me, every trader has bad streaks, you have not wiped out your account. You still have money left. You live to trade another day. That is survival. Tool 2. Stop-loss orders. A stop-loss is one of the most important tools in trading. It is an automatic instruction you give your broker. If the price falls to this level, exit my trade automatically. It removes emotion from the equation. Even if you are sleeping, your money is protected. Example, you buy a stock at $100 per share. You set your stop-loss at $92. This means, if the price drops to $92, the trade closes automatically. Your maximum possible loss on that trade is $8 per share. That is it. Controlled. Tool 3. Risk to reward ratio. Before entering any trade, you must ask yourself 2 questions. How much am I risking? And how much can I potentially gain? The golden rule is to always aim for at least a 1 to 2 ratio. That means, for every dollar you risk, you should be targeting at least $2 of profit. Examples from the slide. If you risk $50, your profit target should be at least $100. If you risk $100, target at least $200. Here is the beautiful part about this. If you follow a 1 to 2 ratio consistently, you can win only 40% of your trades and still be profitable. Think about that. You can be wrong more than half the time and still make money, because your winners are twice the size of your losers. Remember, professional traders do not chase profits. They obsess over not losing money. That is the real secret. Secret number 3. Always trade with a plan. Secret number 3. Always trade with a written plan. I want to say something very directly here. A trader without a plan is not trading. They are gambling. And casinos, markets, always win in the long run against people who have no plan. Your trading plan has 5 key parts. And the critical rule is this. All 5 parts must be decided and written down before you enter the trade. Not during. Not after. Before. Step 1 entry point. Ask yourself, when exactly will I buy? Be specific. Do not say, when it looks good. Say something like, I will buy when the RSI drops below 30. RSI stands for Relative Strength Index. It is a popular indicator that tells you when something might be oversold and ready to bounce back up. We will cover indicators like this in more depth in another video. Step 2. Stop loss. Ask yourself, at what point will I exit if the trade goes against me? Example, I will exit if the price drops 5% below my entry point. Write this down. This is your safety net. Step 3. Take profit. Ask yourself, at what point will I exit when the trade goes in my favor? Example, I will take my profit when the price rises 10%. This is just as important as the stop loss. If you do not plan your exit, greed will decide it for you, and greed usually makes bad decisions. Step 4. Position size. Ask yourself, how much of my account am I actually risking on this trade? Remember secret number 2, maximum 2%. Calculate the exact dollar amount before you click buy. Step 5. Review. After every single trade, whether you won or lost, record it in a trade journal. Write down, what was my entry, what was my exit, why did I enter, and what happened. Also write down how you were feeling when you made the decision. Your journal is where you discover your patterns. It is your most valuable teacher. Here's the key. Once your plan is written, you follow it. No exceptions. No changing your stop-loss mid-trade because you feel like it might recover. No holding past your take profit because you think it will go higher. The moment you deviate from your plan based on emotion, you have crossed from trading into gambling. Secret number 4. Master your emotions. Secret number 4. And this one, I genuinely believe, is the hardest secret of all. Secret number 4 is, master your emotions. This is the secret that separates the 10% of traders who make money from the 90% who consistently lose. And I want to be very honest with you here. The market is designed to trigger your emotions. The ups and downs, the fear, the excitement, all of it plays with your psychology. And when emotions take over, rational decision-making disappears. There are 3 emotional traps that destroy beginner traders. I am going to walk through each one, the problem, a real example, and the solution. Emotional trap 1. Fear. Fear makes you exit a trade too early, before your plan says to. Here is a classic example. You buy a stock at $100. Your stop loss is set at $88. The price dips to $92. Your stop loss has not been hit. But fear kicks in. You panic. You sell at $92 because you are scared it will keep falling. The very next day, the price shoots up to $130. You just missed a $30 gain per share because of fear. The solution: trust your stop loss. You set it for a reason. If the price has not hit your exit level, hold the trade. That is exactly what you planned for. Emotional trap 2. Greed. Greed makes you hold on too long, past your own profit target, hoping for even more. Example: your take profit target is $120 per share. The price hits $120. Your plan says, sell now. But greed whispers, what if it goes to $150? Hold just a little longer. You hold. The price reverses and crashes all the way down to $85. You just turned a beautiful winning trade into a painful loss. Because of greed. The solution: stick to your take profit target. Boys, when the plan says sell, you sell. No negotiation. No exceptions. Emotional trap 3. FOMO. FOMO stands for fear of missing out. It is when you chase a trade after the big move has already happened. Because everyone is talking about it and you feel left behind. Example: Bitcoin suddenly jumps 40% in a single day. It is all over social media. Your friends are talking about it. You feel like you are missing out. So you buy it at the peak, the very top of the move. The next day, it crashes 30%. You just bought the absolute top and are now sitting on a 30% loss. The solution: if you missed the move, it is okay. Say it with me, there will always be another trade. The market is not going anywhere. Be patient. Wait for a proper setup. Do not chase. The bottom line for secret number 4. The market punishes emotional decisions. Every single time. Trade your plan, not your feelings. Secret number 5. Never stop learning. And now, secret number 5, which is my personal favorite. Never stop learning. The most successful traders in the world, people who have been doing this for decades, are still students of the market. They never stop studying. They never stop improving. And as a beginner, this mindset is your biggest competitive advantage. Here is a 3-phase approach I want you to follow. Phase 1. Learn the basics. Before you touch any real money, there are 4 foundational things you need to understand. 1. Candlestick charts. These are the most common way price movements are displayed in trading. Each candle shows you the opening price, closing price, highest price, and lowest price for a given period. Green candles typically mean prices went up. Red candles mean prices went down. 2. Support and resistance levels. These are price levels where the market tends to either bounce back up, that is support, or struggle to break through, that is resistance. Think of support as a floor and resistance as a ceiling. 3. Moving averages. A moving average smooths out price data over a period of time to show you the general trend. For example, the 50-day moving average shows you the average price over the last 50 days. If price is above the moving average, the trend is generally up. Below, trend is generally down. 4. RSI, Relative Strength Index. This indicator tells you whether something is overbought or oversold. RSI above 70 means it might be overbought, possibly due for a drop. RSI below 30 means it might be oversold, possibly due for a bounce. You can learn all of these for completely free on YouTube, Investopedia, and TradingView. Phase 2. Paper trade first. Paper trading means practicing with fake money, with zero financial risk. You make all the same decisions as a real trader, you just are not using real money yet. Use platforms like TradingView or your broker's demo account. Test your strategy at least 30 times before you consider going live. If you are consistently profitable on paper, then and only then, consider going live with a very small, real amount. And I mean small. Start with $50 to $100 maximum for your first live trades. The goal is not to make money at this stage. The goal is to learn how it feels to trade with real money. Because the psychology is very different from paper trading. Phase 3. Keep a trade journal. Record every single trade you make. Every one. Write down the entry price, exit price, why you entered, your emotional state, and the outcome. Review your journal every week. Look for patterns. Maybe you always lose when you trade on Mondays. Maybe you do really well with a specific setup. Maybe you notice that when you trade angry or anxious, you always make bad decisions. Your journal will show you things about yourself that nothing else will. And here is the beginner roadmap, your step-by-step guide. Month 1. Learn the basics. Study every day. Month 2. Paper trade with a demo account. Test your strategy 30 or more times. Month 3 onwards, go live with a small amount, maybe $50 to $100. Then as you get consistent results, you slowly, carefully scale up. Patience and consistency. That is the real edge that most beginners do not have. Summary plus call to action. All right, let us bring it all together. Here are your top 5 trading secrets one final time. Secret number 1. Understand the market before you trade. Know exactly what you are trading before you risk a single dollar. Secret number 2. Risk management. Protect your money first. Never risk more than 1 to 2% per trade. Always use a stop loss. Secret number 3. Have a trading plan. Write your entry, stop loss, and take profit before you ever click buy. Secret number 4. Master your emotions. Control fear, greed, and FOMO. Trade your plan, not your feelings. Secret number 5. Never stop learning. Paper trade first. Keep a journal. Always look to improve. Trading is not a get-rich-quick scheme. It is a skill. And like any skill, it takes time, practice, and discipline to develop. But the people who stick with it, who follow these principles, who protect their capital and keep learning, they give themselves a real chance at long-term success. If this video was helpful to you, please give it a like. It genuinely helps more beginners like you find this content. Hit subscribe so you do not miss our next video. And drop a comment below. I want to know. Which one of these 5 secrets surprised you the most? I read every single comment. This is ELUNA Media. Keep learning. Keep growing. And we will see you in the next one. Disclaimer. Everything in this video is for educational and entertainment purposes only. This is not financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Take care, and we will see you in the next video.